Good afternoon, ladies and gentlemen. Good morning for those of you who are joining us from the Western Hemisphere, and good evening if there are people joining from further east. My name's Elizabeth Sideropoulos. I'm the Chief Executive at the South African Institute of International Affairs, and it's really great to be doing the honors of providing some opening remarks at the start of this webinar, which also launches our new project, which is a partnership with a long-standing friend and partner of the Institute, the Center for the Study of the Economies of Africa, and with the IDRC, also a long-standing partner of both our organizations, Canadian IDRC, International Development Research Center. The project that we're launching, as you know, is the Covid-19 Macroeconomic Policy Research in Africa project, which we began a few months ago. It comes as a result of the rapid response call that the IDRC put out very soon after the COVID pandemic hit the world. And I think it just reflects the foresight from the IDRC's perspective about how critically important it is to actually be able to support research institutions across the world, in the developing world, to undertake research on what is clearly going to be, when we look back and when the history books are written, I think 2020 and the aftermath of it are going to feature starkly in the annals, both in terms of the economics, the health, and the social and socioeconomic implications, and what that meant for the global development trajectory, and indeed, specifically in our case, what that meant for Africa. You've all received the concept note, which highlights what the objectives of this webinar are going to be, really to introduce all of you to this project. This is a project that we're going to be working on over the course of the next 3 years, but also to present some of the initial findings of the work that we commenced about 6 or so months ago in the areas that we've outlined in terms of the macroeconomic impact of COVID on African economies, what the policy responses of African countries have been to the pandemic, the finance options to promote environmental sustainability, and how different policy options impact on marginalized groups. We all know, and it's probably a statement that we've often heard, that the virus doesn't distinguish between those, between colors or races or creeds or anything like that, but we know that it actually does. We know that those who are the most vulnerable are most susceptible, both to the health as well as to the social and economic consequences of it. And if we just look at our own continent here, where over the last several years we've been talking about Africa rising and so on, this is the first year, 2020 was the first year which actually registered a continent-wide recession with a decline in GDP growth of 3.4%. So this has significant implications for the attainment of the SDGs in 2030, for some of the overhang from the Millennium Development Goals from the start of this century. And this all happens at a time when most of our African economies have really, really limited fiscal space, which then also makes the policy space that they are able to maneuver in so much more difficult. Last week, there was a really interesting report that came out of the UN Department of Economic and Social Affairs that looked at the world economic situation and prospects for 2021. And there was a stark figure there, which I thought I would share with you, that for every dollar of stimulus that LDCs managed to roll out in 2020 in response to the pandemic on a per capita basis, the developed world rolled out $580 per capita. I mean, that just highlights again what the pandemic has done. It's accentuated inequalities, accentuated the difficulty of development financing certainly in LICs, but also in MICs. We've seen figures presented that extreme poverty increased by 131 million in 2020. By 2030, we're still expecting to have just under 800 million people living in extreme poverty. We've seen a reduction in 2020 of FDI flows to the African continent to the magnitude of 18% in the latest UNCTAD figures, although it's a little better than the decline that was witnessed in Latin America and the Caribbean. And all of this sort of is, we stir that around in a pot where we're also seeing significant debt challenges, and the fact that the pandemic and the economic and social consequences of the pandemic are not going away very quickly. So the big question that I think African countries are facing, and which I think also underpins this project is does this crisis really present us with an opportunity that we should not let go to waste? How can we ensure that the macroeconomic policy responses will be more, in the first instance, responsive to the huge poverty-related and inequality-related challenges of societies? But equally fundamentally, how can we ensure that the fiscal stimuli, even if they are much smaller in size and scale than they are in, say, the developed world, actually take advantage, are taken advantage of to transform our economies, to deal with the challenges of climate change, and also, critically importantly, to also be gender responsive. One of the big consequences, certainly in my own country, in South Africa, of the COVID pandemic and the lockdown has been gender-based violence. And I think the gender issues, both socially as well as economically, must loom large in any response that we undertake. So these are the big challenges of our time. I think it is the time now to embrace them, but we also recognize that the constraints are actually significant, and so it's often easier said than done. But some of the interventions that you will hear about over the course of this afternoon and over the course of the next 3 years as we roll out the work are intended both to monitor and evaluate, and also to help African economies take charge of some of these really important issues, and not let the opportunity that COVID has provided forget about some of the key issues of our time around climate change, gender, and dealing with inequality and poverty. This project, of course, includes partners. It's not just SAIA and CC and the IDRC, but it includes partners who are working with us over the course of the next 3 years in 2 other West African countries, in Benin and Senegal, and in 2 East African countries, in Tanzania and Uganda, and we're going to be hearing a little bit more about that over the course of this afternoon. Let me stop there, and let me then introduce my 2 other partners in this session. Firstly, a really great pleasure to have you join us, Erin Tanzi, who is the Director of Sustainable Inclusive Economies of the Sustainable Inclusive Economies Program at the IDRC. She is joining us this afternoon from Pretoria, not 7 hours behind us, but it's really great that you're able to join us and to participate in our launch. And just to say that I think not only is the IDRC an important funder, of many, I think, critical cutting-edge projects across the continent. But we have also found in colleagues in the Directorate of Sustainable Inclusive Economies really great intellectual exchanges and intellectual support, which I think has been invaluable for making this project what it is. Erin, over to you.
Thank you so much, Elizabeth. Thank you. And thanks for that really wonderful, quick summary of the current state that we find ourselves in here in Africa and around the world. As you said, yes, I am actually based in Pretoria. I have been living here for 19 years, but the movers just came this morning and I'm on my way to Ottawa, going dead into winter, and I hear that it's minus 20 something. So I have that to look forward to, and I have to find my boots and all my old ski stuff. So anyway, it just seems unreal, but so I'm delighted to represent IDRC at this workshop on macroeconomic policies. I joined IDRC just in November, so I am still learning the ropes, but I have an absolutely amazing team of people within the Sustainable Inclusive Economies division. For those of you that know IDRC, we have been around, well, we're a Crown Corporation of Canada, and we've been around since 1970. So 2020 was our 50th year, which is quite exciting. They've been in this business for a long time. And we were created by the Canadian Parliament, and we get an appropriation every year from the Parliament, to whom we are accountable. So our main mandate is to initiate, encourage, and support and conduct research into the problems of the developing regions of the world and into the means for applying and adapting scientific, technical, and other knowledge to the economic and social advancements of those regions. We support applied research in 5 broad areas. The first one is climate resilient food systems. The second one is education and science. The third one is democratic and inclusive governance. The fourth one is global health. And the fifth one is sustainable inclusive economies, under which this project falls. So as you probably know, IDRC, I think, excels in working with researchers and with research organizations that are based in the global south. We facilitate relations amongst researchers across Africa and with researchers in Canada and around the world. So this project is indeed part of our larger COVID-19 response. I think we have 27 different research projects all under the COVID heading. And many of them are in the economics space, and this one in particular in the macroeconomic space. And so the main goal of this particular project with SAIA is to inform macroeconomic policy development in 6 countries, as Elizabeth mentioned: Benin, Nigeria, Senegal, Tanzania, Uganda, and South Africa, in response to the pandemic. And hopefully that result in more inclusive, climate resilient, effective, and gender responsive measures. I understand the workshop will introduce stakeholders to the project and to discuss some of the initial research findings, which will be really exciting to hear about. So I'm pleased to note that the project researchers have already started really an impressive collaboration across national boundaries, which is lovely to see. And many junior researchers will be benefiting from mentoring and peer-to-peer learning opportunities, which is something that IDRC really takes very, very seriously. We see tremendous potential in this research to strengthen the capacity of the macroeconomic policymaking through locally generated evidence-based knowledge to enhance the long-term fiscal capacity and sustainability of countries in the region. So we're happy to see that there are partners from all 6 countries participating, although I can't see everybody that's participating, but I'm assuming there's lots of people here. So it's my pleasure to see everybody working and collaborating together. So post-COVID-19, green and sustainable recovery and addressing climate change is one of the greatest challenges of our time, as I'm sure you know. So here at IDRC, we're committed to working together with researchers and organizations in Africa to meet this global challenge. this project has great potential to generate new knowledge and capacity in the 6 countries, and working closely, hopefully, with governments, ministries, and researchers from think tanks, and that will support the uptake of the policy recommendations that come out of this research. So I'm looking forward to hearing about what's been happening and the findings that you've come up with so far, and sharing these next couple of hours with you. So thank you so much.
Great, thanks, Erin. Then let me also now introduce and welcome a long-standing partner of the Institute, particularly in some of the work that we've been doing on global economic governance, also a collaboration with us on sort of initiatives on Think 20 related matters, and now also on the COMPRA project. And of course, I forgot also about the Africa portal, where CC has been a key partner of the Institute. But it's really great to be working again with you, Chuka, on this project. Dr. Chukwuka Onyakwena is the Executive Director of the Center for the Study of the Economies of Africa, based in Abuja. Over to you, Chuka.
Okay, thank you very much. Good afternoon, ladies and gentlemen. It's a great pleasure to welcome you all to this launch of this COVID-19 macroeconomic policy research in Africa COMPRA project. It's always a pleasure to collaborate with SIA and as well as IDRC. They've been partners for more than a decade now. CC is an economic think tank based in Abuja. We've been around for 12 years. And what we do is that we advance evidence-informed policymaking in Nigeria, as well as Africa broadly. And macroeconomic policy is one of our key thematic areas, which is the focus of these of this project that we are launching today. And it's quite a pleasure to be partnering with SIA on this very relevant and timely project as the world keeps battling with the pandemic. So in terms of making a few introductory remarks, I'll start by saying that COVID-19 pandemic has been having devastating effect on economies around the world, affecting literally every aspect of humanity. The continent Africa met this crisis in a weak position, as the continent has been battling with persistent socio-economic challenges. The pandemic has also prompted various governments and central banks across the world to come up with a response and recovery strategy in order to avert a chronic economic crisis. These policy responses range from providing tax relief, cash transfers, employee retention schemes, and policy rate costs. Africa has not been left behind, as governments have increased spending plans, about 1.9% of their GDP, and central banks across Africa are increasingly adopting more accommodating monetary policies. However, several African countries, particularly the low-income countries, their responses have been significantly undermined as a result of liquidity constraints, inadequate reserves, and the capacity to raise resources domestically. Thus, this very project, the COMPRA project, aims to better inform macroeconomic policymaking to enhance recovery and long-term sustainability in the fiscal capacity of African countries to address future shocks to their economies. The peculiarities of the LICs necessitates the evaluation of policy responses in order to improve its efficiency and effectiveness and ensure that no groups are being left behind. The limitedness of the policy responses is particularly worrisome, given that the shortage in finance, as external financiers are increasingly becoming overwhelmed, private sectors are wary of holding risky assets, and mobilizing additional domestic financing at this time is likely to pose a challenge. So, as this 3-year project kicks off on a good note, the initial findings from the policy briefs provide recommendations on how Africa can adjust their responses to ensure that certain groups are not utilize the opportunity for a green recovery by peer countries. Lastly, understand the impact of the pandemic on the continent. And on that note, I really look forward to very insightful discussions from the panelists and a good conversation from all participants. Thank you very much, and welcome to this lunch.
Great, thanks Chuka, very much. Before I move to introduce the panel this afternoon, I have been tasked with mentioning some housekeeping. You will see in the chat box, my colleague Cyril has posted a number of links. It also includes the link to the newly launched Compra website, where all the related research up to now can also be found. So put that in your favorites on your particular web browser to be visiting it regularly. During the course of towards the end of the webinar, you will see again in your chat function a link to an evaluation form for the webinar. It doesn't take too long to fill in, so we'd be most grateful if you could click on that link before we finish with the webinar and complete it. It always is useful for us to get feedback from the audience to see how we can improve how we do things. As I said, the new site is there. The publications can be found on that site, and I think Cyril has also posted the link to the to this program and to the bios, the more detailed bios of all the panelists this afternoon. I think that's all from my side. You guys know the drill now when it comes to Zoom. Please do post questions in the Q&A function, and of course communicate. If there are comments you wish to make, of course you can make it in the chat function. But certainly let's try to keep the questions in the Q&A so that it's just easier to manage and to process. Right, that's all from my side. Now I'd like to welcome your moderator for this afternoon, which will be Dr. Bim Adhikari, who is a senior program specialist in the Sustainable Inclusive Economies program at the IDRC, who will take you through the discussion with the panel. It's really great to be working with you, Bim. Bim's been our partner through the proposal process and now through the execution, and we're really pleased that you could join us this morning from a very cold Canada, Ottawa. Over to you, Bim.
Thanks so much. Thanks so much, Elizabeth. And it's really a privilege to moderate this session with the very distinguished panelists this morning. So I think we have enough already, a lot of discussion in the opening session, where we have a lot of background information about this workshop. So as my director Eden has mentioned, I think this is one of the 26 projects that IDRC has supported. And 5 of these projects are more on the macroeconomic side. And particularly this project, I'm kind of very excited that, you're looking at the, that's very strong gender kind of lens, as well as the strong climate lens as well. So yeah, I'm very excited, particularly, having, being part of this project from the very beginning. So without further ado, so I would like to introduce you with 3 of our accomplished panelists this morning. So we have 3 great presentations. So our first panelist is Dr. Adideji Adiniran. He's a senior research fellow at the Center for the Study of Economics in Africa. And he'll be talking about the comparative study of the policy response to COVID-19 in LIC, particularly in the context of Africa. And our second presenter, Dr. Ian Hefferman, who is the assistant professor at the African School of Economics at the Institute of Empirical Research in political economy in Africa, which is based in Benin. And he'll be talking about like one of the focus of the project on the green finance mechanism in developing countries, and both bringing the some emerging practice in this particular field. And our third presenter this afternoon will be Ms. Amara. She's also from the CC, Center for the Study of the Economies of Africa, CC, and she'll be talking about the drivers of disparities, how policy response to COVID-19 can increase inequalities in the developing world. So we are really looking forward for these three great presentations, and then we have three great panelists as well, which I'll introduce later. So just like one or two house rules. So we have like 15 minutes for each presenters. Please try to be on time. So what I'll do is that once you have 15 minutes, 5 minutes left, I'll just raise my this a 5-minute card, and then I have a 1 minute kind of warning, and I hope that you'll be able to wrap up once you see the 1 minute side. So that's a simple rule. And then for the Q&A, I think we really would like to make this session more interactive, more productive as well. So towards the end of the session, so I'm hoping that we'll have like 15 to 20 minutes for our Q&A kind of sessions, and we might go back to the panelists very quickly, and also the presenters as well. So without further ado, so Dr. Adinirana, I think floor is yours. Please go ahead, and your time starts now. Over to you.
Thank you, BM, and happy to be part of this important project. I'll be sharing my slide from here. Hope everybody can see this. Okay, so I will be talking this afternoon on trying to look at policy responses among LICs in Africa, and I'll be focusing on looking at both what countries have been doing and looking at trying to compare what they've done in the past, especially during the global financial crisis. So, I mean, when we look at the policy responses across country, we can look at it in terms of two phases. The first phase is the relief phase. What we mean by relief phase is, I mean, at the peak of COVID-19, when there's a lot of confusion and a lot of country doesn't know how to respond to this. I mean, there was lockdown, there was shutdown, and a lot of other policy responses. So a lot of macroeconomic responses was implemented, given the fact that this is an unprecedented kind of shock on the global economy. So there's a lot of learning that took place during the relief phase. But now, if you look at many LICs and many African countries, with the exception of few where we are having the issue of second wave, most trajectory favors reopening and recovery phase. And that a lot of economy has started talking about how do we start a phase reopening of the economy. So for instance, if we look at businesses and shutdown, a lot of restriction on them has been eased as we move into this recovery and phase of the pandemic. Now, the conversation that I would dwell on this afternoon is just mostly drawn from what happened during the relief phase, and to ensure that we can draw as much lessons as we face recovery phase of the pandemic. So when you look at what happens during the relief phase, in terms of macroeconomic responses among LICs, we look at the scale and quality, and quality by quality we mean in terms of adequacy of policy responses. We can see this is quite modest when you compare with emerging economy, developed countries, and the rest. If you look at the data on size of economic responses among LICs, is less than 1% of their GDP. The only exception are two countries. When you look at the Togo, they are able to achieve up to 7% of their GDP, during the relief phase that we talked about. In total, as at April, you look at total expenditure by African countries is about $37 billion. And two countries is responsible for 84% of that. So that gives you a picture or a concrete kind of idea to tell us that many LICs actually have no financial capacity to effectively respond to the COVID-19 at the peak of the crisis. And when you also compare the economic policy response among the LICs, you can see the number for Africa, about $37 billion. US alone has spent up to 6 trillion as economic responses to COVID-19. And more is still expected to be actually put into to manage the crisis. Similarly, EU, as it's April of 2020, has injected about $500 billion stimulus package into the economy. And even at this, what this is telling us is countries has responded significantly to this crisis. But when you look at what LICs are doing, they were unable to do much of what their other counterparts are doing. And that gives, or we can ask a lot of questions, to understand the factors shaping the various economic crises, to compare their responses to what has happened in the past, especially global financial crisis, and to understand what worked and where and what lesson can be learned as we move into the next phase, which is the recovery effort. The task is not to answer all these questions, but because this is in a way what all we'll be doing in the entire 3 years. But to start looking at what has happened and use it to frame how we understand the process as we move forward along this line. So in this analysis, we look at 3 policy domains: fiscal policy, monetary and macro, financial policy, and exchange rate and balance of payment policy. And under the fiscal policy, there are many measures that countries were able to use, among LICs in Africa or Africa broadly. One is emergency budget support for health system. We also see and witness a lot of social protection for vulnerable households in the form of cash transfer and debt moratorium. Also, there are financial support for small and medium-scale enterprises and informal sector. A lot of countries draw down on their savings. So you look at the countries with savings, especially those with the sovereign wealth fund, were able to draw down on sovereign wealth fund and use it as part of measures to respond to this. But when we talk about fiscal policy, we are talking of 2 sides of the coin. One is the expenditure and one is the revenue. And you spend more with more revenue. And one of the problems we see among LICs in Africa is inability to actually generate revenue. This speaks to every country, but it's more prominent for the part of the world where domestic resource mobilization is already a major issue. So by estimates, African government revenue is expected to decline by 12% in 2020. So what this picture in terms of fiscal policy tells us is this. A lot of countries have used these various measures in terms, budget support and the rest. But the major thing we see in terms of looking at the budgeting process among countries, more of the support has come in form of emergency budget support for health system, whereby we're able to use initial phase of finance for building health responses. But given what I mentioned earlier in terms of the small size of responses, this is not enough. And that speaks to the fact that when we talk about social protection, even though there is a lot of social protection policy that were introduced, a lot of these still were not able to cover a significant part of the population, especially given that the benchmark poverty level in most of these countries are quite high. So in terms of monetary policy and macro financial policy, also we see a lot of LICs introducing measures around expansionary monetary policy. And why the factors that is actually driving use of whether monetary or fiscal policy is how much space do countries have in terms of fiscal policy. And what we see is going into this COVID-19 crisis, a lot of countries in Africa, LICs inclusive, are already on the brim of debt challenges. I mean, debt issue has already become elevated concern going into the crisis. So crisis simply amplified this. And when country lacks fiscal space, a lot of tends to resort to expansionary monetary policy. But even when this tool is available with weak development of domestic financial system, that does not help. Also, we see a lot of them taking up pseudo fiscal policy like having to actually provide grants to businesses. I can say that a change in interest rate and a central bank in a number of cases actually rely on moral sanction and forward guidance in order to ensure they could deliver more. So we see a lot of nudging and urging of commercial banks and private individuals in terms of central bank policy. Exchange rate was not much used among LICs in Africa, so I won't discuss much about this. Just to quickly jump into donor support. So this graph is showing us how much support vis-a-vis need. So in the light blue one, you see the total financial requirements, and in the dark blue, you see in terms of how much they are able to get. So you can see that there is financial gap among every country. No country was able to get as much resources as it could. So, which means that donor support was crucial, but in essence, it's also not sufficient to meet the financial needs of LICs in Africa. Also, there were some other forms of donor support in terms of debt relief and more, and the rest. China was also very crucial support in terms of debt relief, debt service suspension for many countries. But we also see donor support, philanthropic support from private sector, which is quite crucial in terms of health policy responses, and might even be more crucial as we look into the next phase, whereby we talk about vaccine nationalism and the needs to actually get countries. So in this area, developed countries are now helping, and no country is helping. So, but private philanthropic effort has been crucial in this area, and we see that this will be very, very important going forward in terms of response. But the conclusion here is this: donor support was crucial, but it's more along health system support, and quite lacking in terms of macroeconomic, in terms of budget support for other areas of the economy, like supporting informal sector, like supporting job loss and the rest. So that's one crucial area that we need to look into for the recovery efforts. So we look at trying to gauge how effective has been this economic surplus, and we try to combine based on the generic metrics in the literature in terms of index of economic stimulus, trying to gauge what is the scale and quality of economic responses by countries. We compare this with pre-COVID-19 indicators like GDP growth, debt, revenue, primary deficit, and with epidemiological indicators like death from COVID-19 and COVID-19 cases. And if you look at, in terms of looking at the economic stimulus itself, we only see one exceptional country that performed very well, which is Senegal. is the only country that was able to respond effectively among LICs, I mean, in terms of the quality of their responses to the crisis. In terms of when you compare GDP growth rate, so we look at what was projected for 2020, what was the figure for Q1, and what was the figure for Q2. And you can see that in most cases, country performed far below what was projected, which means the projection, especially by IMF, was actually quite too optimistic. And countries that actually rely on such an optimistic estimate were unable to actually respond. And that is the story you see in second quarter in terms of nose driving in the economic growth among these countries. Similar story when you compare first quarter and second quarter GDP growth. But I mean, when we put this thing in terms of what happened vis-a-vis between economic response, quality and scale, and these indicators, I mean, two things to highlight here is better responses is seen in countries with more cases, but surprisingly, we are not seeing more countries that recorded more deaths also have poorer level of in terms of quality and scale of economic responses. These figures that we are showing here is just for LICs in Africa. So it's just a story about LICs. And when you see in the second line of stimulus index versus debts, government debt, we can see that countries with huge debt were unable to respond so much, and that is the story being told by that downward sloping line. But when the converse is the case that country with larger government revenue to GDP were able to respond better, which means fiscal space is actually one of the key factors that explain ability of country to respond to the shock. In terms of country inflation rate, a country with more inflation, we don't actually see much more effect around the effect of inflation in terms of stimulus responses, and similar for primary deficit in terms of how it affects. So in a way, what this the story we can deduce from here is quality and scale of responses are actually driven by pre-pandemic factors, and the key factors are fiscal space and the other factor is in terms of ability, the cases, COVID-19 cases recorded by countries, also the second factor that is quite prominent in terms of country ability to respond. These slides try to compare economic policy and effect of COVID-19, looking at the global financial crisis of 2017 and 2018 and what we have at present. And in all indicators, I mean, if you look at in terms of the size of effect on the economy, I mean, COVID-19, in terms of transmission mechanism, we're able to feel the effect within 3 months. For most developing countries, I can see that 1 minute more. For most developing countries, the effect has been less. But just to summarize what I have on this slide, the key thing here is COVID-19 effect is different from global financial crisis. The effect on LICs is much bigger, and LICs in many cases enter into COVID-19 amidst a great kind of unease at the economic side. Before global financial crisis, there was debt forgiveness, which makes room for a lot of countries to respond effectively to this crisis. But for COVID-19, many countries are already on the verge of debt crisis, and that reduces the effectiveness of their responses. The implication of this is what we are already seeing. During the global financial crisis, poverty rate in Africa did not rise, but just within 1 year of COVID-19, we already see many projections pointing to the fact that we would have an elevated poverty rate. Also, we know from all indicators that economic growth was slightly lower for African countries during the global financial crisis. it's mostly negative for COVID-19. So COVID-19 is a unique crisis that we cannot compare to global financial crisis. So we need bigger and bolder kind of economic responses. And LIC's capacity is constrained in this regard. And we need to draw on whatever strength we can draw on. And that we need to look at, not just, we need to look inward domestic resource revenue, but we also need to look outward donor support. Global South support too will be crucial in our response. So these two next slides just talked about key lessons that we have learned and what we need to do for in looking forward. So it's about our ability to harness multiple policy, ability to use data to drive our policy responses, needs to leverage on international cooperation, and for us to look at structural barriers that makes nations unable to respond effectively, such as digital inclusion, social inclusion policy, and the need to develop local financial market. So those are the kind of thinking we need to have going forward. Thank you so much.
Thank you so much, Adidesi. I think it's very nice, very comprehensive overview of the fiscal and monetary response to the COVID-19 by the countries. So two of the quick point I kind of noted from it, like one of the sides of the global stimulus, and also disparity between the global north and south. What is the, in terms of looking at how much actual money, going to the local populations. And also, not only that, if you look at the OECD data by, I think, July 2020, out of that, the $11 trillion injected to global economy, almost like around like $170 billion also went to the very, carbon intensive sector, like a fossil fuel industries. So I think, and there's a lot of fear that, because we might going to, whatever progress we have made on the climate change, filed from the last many years, and there's a kind of, danger, that kind of stimulus is, putting a pressure on the environmental climate side as well. So I think it's a nice segue for our next presentation, which is more on the green financing mechanism. Perhaps I'm guessing that, the presentation might discuss, how developing country or developed country approaching this green finance issue and what are the current emerging issues are. So now I'm going to Dr. Ian Hafferman. So he's going to talk about the green financing mechanisms. Ian?
Thank you, Dr. Bahim.
You have 15 minutes.
Share my screen here. Okay, thank you for having me here. I'm going to be presenting on a rapid response policy paper that was written by Palisa Shipalana. Unfortunately, she couldn't be here with us, so I'm kind of taking her her place here. Sorry, 1 second. Okay, so basically I'm going to be talking about sort of three aspects of the response to COVID-19 and how it can be directed towards environmental policies. So environmentally sustainable recovery from COVID-19. So we're going to be talking about the central bank's response, the public sector response, and the private sector response. And all three of these factors are going to be integrated with each other. And so you'll see that throughout the presentation. And so just to begin, environmental risks are not taken into account into the Basel III, which provides the main regulatory guidance for the global banking system. So central banks have a role to play in greening the financial system, especially in developing economies where environmental regulation is weakly implemented. And so the potential tools available to central banks are the introduction of green macroprudential regulations and climate-related stress testing. So this is quite important because, as we know, climate is directly related to the economy. And so the central bank, it would make a lot of sense for the central bank to consider climate considerations when it's making its when it's implementing its policy, because policies chosen today are going to affect the economy in the future through climate. And green policies today are going to benefit the economy by reducing the probability of negative economic shocks that are associated with climate-related disasters. The second thing the central bank can do is it can direct green credit policy instruments. It can require separate reserve requirements for green assets. So this would encourage banks to hold more environmentally friendly assets on their books. So it can develop, the fifth thing it can do is develop green finance guidelines and a framework for greener lending. So this can help banks to classify their lending activities in green and not green in an easier way, which allows investors to target their investments towards green assets. The sixth thing it can do is create mandatory disclosure requirements for all financial organizations in their public financials. So this would help this would give confidence to the public that the assets that they're truly buying are green if they claim to be green assets. Okay, so the global green bond market rose from 155 billion in 2017 to almost 250 to 300 billion in 2018. So issuing green bonds can become an important financial mechanism to support a green economic recovery. Green bonds have a big potential for growth with investors, keen on containing global warming, but avoiding negative credit ratings. Okay, so green bonds tend to be oversubscribed and have the advantages such as tax exemptions, making them a good options for countries that had to approach financial institutions like the IMF for funding to mitigate the effects of COVID-19. So what I mean by oversubscribed here is that when you're issuing green bonds, investors tend to overbuy them, which gives the issuer a better rate of return on their debt than they could get for non-green bonds. So it makes them financially more attractive for the issuer, and gives the issuer access to cheaper credit. So first-time African sovereign green bond issuers will need to develop a green framework legislation. So this is where national governments come into play. This will encourage green finance, promote transparency, and signal commitment to green finance in global markets. So the purchasers of these green bonds need to be assured that the assets that they're purchasing are actually green. And so governments and central banks need to develop legislation and frameworks that effectively convince investors that they're buying green assets. So there's numerous international protocols along these lines that national governments have adopted in order to encourage and convince investors that the assets that are being issued truly are green. Okay, finally, governments can make public policy shifts in favor of greener and more climate resilient economies, while also creating fiscal policies that make holding green assets more attractive. So in many countries, buying green assets, you get a tax break, which then makes holding green assets more attractive. And given that these bonds are already oversubscribed, this just further encourages investment in this region, making issuing much more attractive to developing countries. And so there are developments that make the continent a prime candidate for funding through green sovereign bonds. Especially, this is especially the case because a lot of African countries are very prone to climate disasters, and issuing green bonds are an effective way to mitigate this. So the next thing I'm going to talk about is environmental funds. So climate finance has led to a broadening of scope and mandate of environmental funds. So environmental funds have become a vital mechanism for implementing of national action plans and green programs. So key success factors of environmental funds include a strong government commitment to ensure that the environmental funds are used only to provide funding and technical expertise, building capacity, and supporting transparency in a green economy. And so these environmental funds can support strong government systems and representation from diverse sectors. They can provide long-term financial commitment with strong legal and financial practices. Government funding should be used to capitalize environmental funds and also to act as stimulus to crowd in private and donor investments. So EFs should, however, be aimed to have a diverse revenue stream in the medium and long term. They should have clear priorities in order to help attract grant funding and fund innovative and strategic capacity building programs to support and strengthen domestic capabilities. So a lot of the success of environmental funds will depend in the same way on that green bonds have the similar success factors. There needs to be a clear, transparent protocol for assigning, for allocating the green funds. And then this will help encourage private sector investment as well. So the environmental funds can provide an initial level of capital, which then can encourage private sector investors to also move into this space as well, as they as these environmental funds have given an initial level of capital, which greater ensures or helps ensure the success of these projects. Okay, so other market-based mechanisms. So governments must improve the policy and regulatory environment in order to attract private sector investment for climate resilient programs and create market-based mechanisms to incentivize the private sector. So for any market strategy to be successful in unlocking green finance, should focus on de-risking by providing long-term grants and concessionary findings to an investment. So this is what I was talking about with a bit of the green funds. So the government can, through the green funds, can provide an initial level of concessionary financing, which helps ensure the success of the project, which will then attract private sector investment. So they can provide credit enhancements, which will attract private capital to sustainable green investments and serve to particularly de-risk investments. So credit enhancements could be tax breaks on the capital gains obtained from a green project. They can allow co-investments by the private sector and create umbrella facilities to local financial institutions, especially small and medium enterprises with good investment opportunities, but with high transaction costs. So a lot of these smaller environmentally friendly projects are going to be needed to be financed by local institutions because of the high transaction costs of investing in these smaller projects. And these can be done through the creation of green or ethical banks, where ethical banks are banks whose lending is guided by a set of principles other than profit maximization. And green banks are dedicated to green investments with the aim to fill local markets' climate investment shortfall. So these green banks will also, if they classify as green banks, should get lower capital requirements by by central banks, reserve requirements, sorry, and subject to special tax breaks to encourage investment, private sector investment in the green economy. Okay, next I'll talk a bit about green fiscal reform. So this is the government side of the green recovery. So there's a range of fiscal reform instruments that are suitable. Different instruments are suitable for different countries and different sectors. So green fiscal reforms can be a valuable instrument for medium and long-term rationalization of inefficient expenditure. So given the need to increase aggregate demand currently through government expenditure, green projects that may not be efficient today can be implemented due to the large demand for government expenditure, which can then have long-term payoffs in the future. So these green projects will have the benefit of producing or increasing aggregate demand today by providing public sector jobs and private sector jobs, and then have long-term benefits in the future by lowering energy costs and reducing the country's vulnerability to climate-related disasters. So green fiscal policy instruments can help generate and reallocate significant resources for economic recovery measures. So that's a bit of what I just talked about, where spending today can alleviate the adverse economic conditions and then also provide long-term benefits. Another aspect of fiscal reforms would be removing harmful subsidies in other sectors. For example, the fossil fuel sector, for example. So Egypt has halved the fiscal cost of subsidies to bring average electricity tariffs closer to cost recovery. However, there's a lot of barriers to doing so. Fiscal reform has not yet taken off due to obstacles such as lack of political will, limited transparency. Okay, so I have 1 minute remaining. Okay, so I'll just finish up here. But to assess all of these green reforms need to be viewed in the light of efficiency and distributional implications. So changing tax policy is going to benefit some while harming others. So we need to ensure that we're not raising the costs of energy for the poorest in society, making them worse off, and then reallocating that money to green-friendly sectors. So, for example, the poor probably rely a lot on fossil fuels for transportation, and so any sort of carbon tax, which is environmentally friendly, may have adverse effects on the poor. So these need to be taken into consideration and offset by other fiscal tools. For example, redistribution. So if a tax is placed on fossil fuels, distributional concerns would call for redistribution using other tools. Okay, so let me just conclude. Let me just conclude with 5 key pillars for a green recovery package that can be adopted by African countries. The first pillar is to build network infrastructure required for a green and just transition. The second is to make regulatory changes that unlock private sector investments in sustainable energy, water, waste, and sanitation systems. The third is to support localized manufacturing technologies through green banks and ethical banks. The fourth is to improve access to sustainable services. And finally, the fifth is to implement fiscal reforms in a green manner. So thank you for your attention, and thank you for the time.
Thanks so much, Jan. So I think there are a few things for us to follow later. Particularly, I think from this is a very nice overview of the green financing instrument. Maybe I think when you go to the panelists, maybe we can a little bit expand that, how some other country are approaching them, or more like, kind of ground level type of, implementation of this instrument. We'll go to that. So I just, there are a couple of questions already and on the Q&A boxes. So if any panelists would like to respond to them directly, please do so in writing, because later we might not have enough time, to go them one by one. Please feel free to respond to these questions. Now, okay, let's move to our final presentation from Ms. Ma Amara. So she'll be talking about the disparities, how policy response to COVID-19 increase inequalities. So Ma, over to you. So you have 15 minutes.
Thank you, Bim, for that kind introduction. I will quickly share my screen.
Sure.
Okay, so today I'll be taking us through the paper on drivers of disparities. So how the macroeconomic policy responses that have been deployed so far can increase inequalities. Just to start as an introduction, it's important to note and to also assess the several forms of inequalities that already existed before the pandemic started. So high poverty levels, high gender inequality, high informality as well. Broadly speaking, up to 80% of labor in sub-Saharan Africa are employed in the informal sector. High financial exclusion as well, not so much for firms, but for individuals, where about 17% of the unbanked individuals globally reside in sub-Saharan Africa. Also, in access to finance, not up to 20% of small businesses in the continent have access to loans. SME dominance and digital exclusion. A lot of people do not have the new technologies, whether it's mobile phones or internet, which makes it difficult to provide financial services to them. Now, moving on to the crux of the policy brief, where I assessed the specific macroeconomic policy responses that the Nigerian and Ugandan governments have deployed, and also assessed the segments of the population that are being left behind. So basically, how these policies are exacerbating existing inequalities. The first, the cash transfer program. Before the pandemic started, both countries already had existing cash transfer programs. In Nigeria, we had the conditional cash transfer program where 5,000 naira is offered to beneficiaries, the poorest of the poorest. In Uganda, there's a range of cash transfer programs: Urban Cash for Work program, social welfare program, social assistance grants for empowerment, which is targeted at the elderly. The eligibility criteria for that is about 80 years and above. And what happened was, once the pandemic set in, these programs were expanded. So in Nigeria, the households that are eligible for the cash transfer program, it was increased from 1.1 million to 3.6 million households. In Uganda, the existing cash transfer programs, the government increased funding for these programs. And while these are steps in the right direction, the cash transfer programs were still very small with regards to size. So for both countries, it was less than 0.01% of their economic output, more so for Nigeria than Uganda because of the large population in Nigeria. Another issue was the limited scope. So it excluded a lot of the poor people. Over 80% of poor households were excluded by the cash transfer programs. And a third issue was targeting. The cash transfer, so the mechanism through which beneficiaries are identified in Nigeria is flawed with regards to responding to the pandemic, just because it targets the poorest of the poorest. So the the poorest 30%, the poorest households in the poorest local government areas in the poorest states. And as such, a lot of the beneficiaries are in rural areas, and also, they're agrarian. They rely on subsistence agriculture, whereas these cohorts were not they didn't feel the brunt of the economic impact of the pandemic. A lot of the people that felt the brunt were, the urban poor, whether it's the drivers or, informal sector workers, to an extent as well, formal sector workers. And so it was the targeting of the cash transfer program in Nigeria was flawed. The same issue also comes up in Uganda, where the programs that received the highest allocations, the Urban Cash for Work program, which is a labor-intensive program that provides economic opportunities to the poor, it's difficult for that to take place when lockdowns are being put in place, when there are restrictions to movement. And so as soon as the pandemic started, these programs were not necessarily beneficial. Another program that benefited from large increase in funding was the Social Assistance Grants for Empowerment program, which, as I highlighted earlier, the main beneficiaries are the elderly, which again do not face the economic impact of the pandemic. Moving on to the second set of policy responses: tax relief, debt moratoriums, loan restructuring, targeted credit facilities. So both countries as well, the governments deployed these policy responses. I won't bore you with the details, but it's highlighted here. And the major issue with this is that the informal sector is being left behind. Access these policy responses. A lot of them have low literacy levels. It's difficult for them to understand how to go about accessing these policy responses, and so a lot of the informal sector workers were left behind, affecting women and those in the agri sector more disproportionately. And in Nigeria, another issue that came up is the collateralization of the credit facilities that were provided, whether it's to the manufacturing sector, the real sector, the health sector, and SMEs. And so what happens is, not only are the informal businesses being left behind, but even formal businesses that do not have the collateral to access these loans are also being left behind. The third policy response is the policy rate reduction. So both central banks reduced their policy rates in a bid to make loans more accessible to the private sector. However, this fails to reflect in the interest rates being and low-income borrowers, particularly youths and women, more disproportionately. Moving on, the fourth policy response is exchange rate adjustments. This happened in Nigeria, not in Uganda. Nigeria, we had a hit to our major source of foreign exchange, oil, and so we had to readjust our exchange rates, and it hit us pretty bad, considering that we're an import-dependent economy. We've seen inflation rise, partly as a result of this, by over 3%. Inflation is currently about 15.75%. We've seen inflation rise considerably, and it's affected the poor more disproportionately, and also the manufacturing sector as well, considering that a lot of their inputs are imported. The next policy response is the increase in fuel price and electricity tariff. It's important to note that while other countries were halting utility bill payments in order to alleviate the burden on citizens, Nigeria had to rather undertake, commendable policy reforms, but still devastating to the populace, where we removed the fuel and electricity subsidy, and this resulted in an increment in fuel price and in electricity tariff. And the segments of the population that are particularly affected by this are the middle class and the rich, considering that they were the they were the major beneficiaries of the initial subsidy program. Also the poor as well, but the middle class and the rich more disproportionately. Looking at budget restructuring that took place as a result of the pandemic, whether it's in form of supplementary budgets or whether it's in form of 2021 budgets, and putting into consideration, what's the pandemic has impacted. The major finding is that the budget restructuring was done with a post-COVID focus, where the key sectors, where the key sectors that were the major beneficiaries in Nigeria: works, power and housing, agriculture. These are sectors that the government has identified to hold significant economic opportunities in the post-COVID era. And so a lot of the budgetary allocations, went into those sectors. Similarly for Uganda as well, where the Uganda Development Bank, that provides finance to businesses that are export-oriented, benefited significantly from the budget reallocation. And while this is great, again, it's a step in the right direction. Sectors that will provide support in the near term were more or less, shortchanged. So an example is Nigeria, where the budgetary allocation to the education ministry, the health ministry, and humanitarian affairs, which covers the cash transfer programs that is being undertaken. The budgetary allocations to these ministries were reduced with regards to budget restructuring is countries. It's looking at the budget restructuring. It's clear that a lot of money is going into servicing debts. For Nigeria, upwards of 60% in 2020, went into servicing debts. For Uganda as well, closely after the allocation to the Ugandan Development Bank, the next was debt servicing. And the next slide shows a snapshot of the excluded segments of the population. So the segments of the population that the policy responses are not catering to, or are leaving behind. And what's important to note is that there are certain cohorts that are being excluded by multiple policies. We see the urban poor, we see women as well, we see the informal sector as well. And this is happening across countries, across both countries, Nigeria and Uganda. And a few recommendations based on this initial analysis of the policy responses that have been deployed. First is for governments to broaden available finance, not only to cater to this, to the women, the informal sector, and the urban poor, but also to the other sectors that are in dire need of support, by leveraging on newly available funding sources, sovereign wealth, and other savings funds. Nigeria has done well in this regard. We've drawn on our sovereign wealth. That's the purpose, to save for the rainy day. So we've done well with that. The second is to expand digital financial inclusion and the adoption of electronic platforms to access hard-to-reach populations. East Africa is a case in point in this regard. The M-Pesa made it relatively easy to provide cash to the vulnerable population, and even the vulnerable population in hard-to-reach areas. Other countries can learn from this. The third is to promote investments in renewable energy, where on average, renewable energy is more affordable than non-renewable energy. So to promote investment in renewable energy so as to reduce the electricity cost, particularly for poor and vulnerable groups. Fourth is take debt sustainability and management more seriously, not only because we're spending so much on debt servicing, but also taking into consideration that we're even starting to take on more debts. Both countries and even countries across the continent are accessing the IMF's Emergency Financial Assistance Program. Debt projections are skyrocketing, and it's important for countries to properly evaluate the costs and risks with regards to all the debts, all the creditors that are providing the finance. And I will end it here. Thank you very much for listening.
Thanks, Ma. Thanks, Ma. Excellent. It's a very, very interesting and comprehensive presentation. Thanks for that. So we'll get back to you later in our Q&A session. So now I'd like to go to our panelists. So we have our 3 panelists. So what we'd like to do is that as panelists, I think you can really pick up, one of these presentation depending on your specialty or your expertise. And either you can little bit provide feedback or critics as well, or if there are any other similar kind of study also going on, I think we really would like to get this kind of feedback as well. So our first panelist this morning is Dr. Oswald Masihindo. He's from the Tanzania at the Economic and Social Research Foundation, and who is the senior research fellow there. And our second panelist, Dr. Susan Kavuma. She's also research associate at the Advocates Coalition for the Development and Environment in Uganda. And finally, we have Dr. Arthur Minsad, who is the head of the Africa Unit at the OECD Development Center. So I'll start with Dr. Oswald. So please, yeah, you have like 5 minutes max. Please be taking time. 5 minutes. So please feel free to comment, any aspect of this presentation. Either you can, tackle like all 3 presentations together, or if you feel that you're passionate about some specific kind of issues, please pick up one of these presentations and tell us what do you think, what are the critics, and what feedback you can give us. Dr. Oswald, the floor is yours. Are you there? Good.
Yes, I'm here.
Good.
Thank you very much, Dr. Bim, and I also thank the presenters for the interesting presentation. I will just very briefly give my views on macroeconomic policy dynamics of response, and then maybe the presenters can pick up whatever they think is useful. First of all, I must acknowledge that these are very relevant topics. The policy response, the green financing, and the last one, the disparities, especially now when the world is under this situation, going through the second wave of the pandemic. Let me start by pointing out that the interventions and the measures which are taken across the countries in Africa to slow down the pandemic, in fact, these are necessary and inevitable if we need to minimize costs of this pandemic in Africa in terms of resource depletion and in terms of death. I'm sure we all know that in Africa, there are different players, but I would say the government and the other players or other partners, such as the private sector, the COCOs, the business community, etc. All of them need to play a very central role in addressing this this pandemic. And I'm saying this because, particularly because I find it important because Africa is the poorest continent and is economically weakest continent in terms of the incomes, in terms of the power of our local communities and members of the communities. So it's very important that these key players or partners play this central role to address the problem. And in my view, the success of most methods, the success of most of these approaches which different countries in Africa are taking of dealing with COVID will largely depend on the performance of macroeconomic interventions, because macroeconomic policy is key to enable other interventions become effective. For example, you cannot successfully sensitize the communities about this pandemic successfully, or you cannot be able to distribute the required materials like sanitizers or masks without stepping up macroeconomic measures, etc. So various fiscal and monetary interventions are inevitable if Africa is to remain free from this problem. In Tanzania, very briefly, a number of these fiscal and monetary measures have been taken to reduce the impact of the pandemic. For example, some businesses here were running out of liquidity when we started with wave one. So immediately the government decided to clear all domestic payment arrears and value-added tax refunds to help business remain liquid during that period. And some private sectors and business communities were having difficulties to obtain credit from the banks and the financial institutions. And the central bank immediately intervened by taking a number of monetary and fiscal policy interventions. For example, the central bank lowered the statutory minimum reserves from 7% to 6%. And they also, the bank also reduced the discount rate from 7% to 5%. All these in order to enable the banks and the financial institutions borrow additional funds from the central bank. The bank also allowed the waiver of interest and charges for those who had the overdraft facilities. They were rolled over. They were given more time to pay. Even the non-performing loans were also restructured to enable people have money for a longer time, but also be able realistically to pay the loans. The interest rate for the treasury bills and for the treasury bonds were also reduced. Treasury bills from 10% to 5%, and treasury bonds from 40 to 20%. All these to increase the liquidity of the commercial bank to borrow from the central bank. And even the mobile money customers were allowed to transact more money. It used to be 3 million per person or per dealer, but the government decided to push it up to 5 million. Even the minimum balances, which they were supposed to keep, they increased from 5 million to 10 million Tanzanian shillings. So these dealers were able to inject more money to the public because in Tanzania, mobile connections is more than 75% of the population by this time. The government also worked
Dr.
very
Schwal,
hard.
can you wrap up like 30 seconds now? Thank you.
Yes, for sure. And there were a number of other measures which were taken by the government to address the problem of the COVID-19. And the impact generally, the real economic growth, for example, nearly maintained its growth of 6% before and during the pandemic. And for sure, largely this was because of the interventions which were taken. I should also mention that the budget for the health sector was increased. The government decided to increase that because the sector needed more money. And despite the fact that most of the private health facilities which were benefiting from this change in budget were not benefiting the majority poor in Tanzania, because to access health services from the private facilities is unaffordable to most of the Tanzanians. And not only that, most people here cannot access the health insurance, so they cannot use the health services from the private sector. So this is the effect of some of these interventions to the poor.
Thank you so much.
Thank you, Dr.
Thank you so much. Sorry to cut you off, but we have still two panelists and we have some questions there as well. Thank you so much, Dr. Oswald. I know we really appreciate that. So now I'd like to move to our second panelist, Dr. Susan Kabuma. Susan, perhaps I think given your expertise in the environment and development kind of side, so I wonder if you will be able to, offer some remark for our second presentation on the green financing kind of instrument, particularly, bringing like a country's kind of perspective. What are the potential, some of this instrument, country can try out. So yeah, in addition to, whatever you would like to share with us. So you have like 5 minutes max. Over to you, Susan.
Thank you, Dr. Bim, and hello to everyone. I'm going to make a comment on the impact on inequalities, the macroeconomic policy response, and the impact on the inequalities or disparities, where I have more expertise and I think where I contributed to the study. And since I'm given only 5 minutes, I'll just give remarks. I'll not make any presentation. First of all, I want to thank my colleague Ma for the wonderful presentation, which was really comprehensive. And I don't want to repeat, but just to emphasize a few issues that indeed countries, low-income countries, had the different dimensions of inequalities, which in my view, some of the policy responses have exacerbated these inequalities. And this is simply because of how, the policy responses were designed in terms of targeting, coverage, as well as the design. If I can give a few examples in Uganda, for example, the first speaker talked about the 2 dimensions of relief and reopening the economy. During the relief phase, Uganda had food relief that was given to households during the total lockdown. But unfortunately, the coverage was small because they targeted mainly households in urban areas. And we know that even rural areas, they are poor households. Okay, the argument was that rural areas are able to grow their own food. But when you look at our statistics, there are rural areas that are food insecure. So there was exclusion, in the policy response. But even in the urban areas, not all eligible households were covered. And also there was a lot of time taken to cover the households. So there were issues of exacerbating some inequalities and excluding some people. When you look at the social protection for the elderly, the senior citizens grant, that was a very welcome cash transfer because it was piloted in a few districts and government decided to extend it countrywide. But unfortunately, the eligibility age was increased from 65 to 80. And we know that our population of the elderly is small. Once you increase the age, then you have few people who are eligible. So that is another challenge, which is about the design of the program, such that it's likely to target a few people. And when you look at the financial sector, there was a response, as Ma explained, that there was a reduction in the CBR, central bank rate. But we have a challenge that there is that non-responsiveness of interest rates for commercial banks. And therefore, firms continued to incur high costs of capital, which is still a challenge. But even when you look at on the side of government expenditure, giving credit, recapitalizing the bank, the development bank, to provide credit to SMEs, we realize that when you look at the eligibility criteria, the micro firms that employ less than 5 people are excluded, and yet there are very many. Actually, they are more than the small and medium firms. So that is another form of exclusion. So in summary, the policy responses were good, much welcome, focused in the right direction, but there were challenges of targeting, challenges of coverage, and the design of the programs, maybe which goes back to these farms also. Our country is having little funds to finance universal programs or wide coverage programs, which brought a challenge in addressing the effects of the pandemic. Thank you so much.
Thank you so much, Susan. I think you're right on time, which I really appreciate. Now I'd like to move to our third panelist, last but not least, Dr. Arthur Minsat from the OECD. So Arthur, I think we have heard so many things already there, but particularly there are a few questions on the chat box as well. I think one particular question I picked was on the, okay, there are a lot of support from the, coming from the developed country to developing countries, but simply, there is no efficient use of resources because of the, weak policy, kind of, weak institution, and then also more like consumption rather than a more productive type of kind of investment there. So I wonder if you'd like to kind of pick up in one or two of these questions and anything you would like to share with us. Over to you, Arthur.
Thank you very much, Dr. Beam, and thank you to all the panelists. It was an excellent discussion, and I'm delighted to be here. Thank you to the colleagues from SAIA for organizing this excellent discussion, and congratulations to Elizabeth for being appointed to serve on the high-level UN Advisory Board on Economic and Social Affairs. I'll focus on one big message, which is the COVID-19 global recession calls for a global New Deal, where Africa is at the center of the global recovery. And then I will highlight 4 policy areas. I won't have time to go into all, but the 4 policy areas are the following. First one on financing Africa's development. The second on structural policies for digital transformation. Third on value chain and the infrastructure, development of infrastructure for the continent through investment. And fourth, as was emphasized before by Mary, on the green recovery. And finally, as also emphasized before, on the social inclusion. Thank you. So, just to respond quickly to the question on the chat first, that directly relates to the challenge of financing Africa's development, particularly for the least developed economies. Let us recall that with regards to the ODA, so levels of overseas development aid, if we look at the donors have pledged to maintain the ODA at the pre-crisis level, but given the amplitude, the magnitude of the crisis, this would still imply a fall in net ODA levels by between 11 to 14 billion between 2020 and 2019. And if the crisis continues, it could further be amplified just if we keep the same percentage because of the the GDP of the countries is lower, and the government budgets as well. And this will of course have an impact on the least developed economies, for which 52% of the financial inflows into the African LDCs consist of ODA. And if we compare with the middle income countries, it's 11% only. So there is a lot of discrepancy between heterogeneity between the different countries. So that's to answer the question that was posed on the chat. So let me come back to the first point, that we need a global New Deal, and that Africa is at the center of the global recovery. Before the crisis, the African continent had the second highest growth rate in the world at 4.2%. Of course, there were vulnerabilities before the crisis that have been exacerbated, but Africa remains and will remain for the coming decades, the opportunity not only for investors, but also for the growth of markets through the growth of its population, the continental free trade area, or the rural-urban transition. Let me remind that FDI flows into the continent grew at 8.5% between 2000 and 2019 before the crisis. So they grew fourfold, which shows the magnitude. At the same time, it's relatively small by a global comparison, because it's only 3.5% of total FDI flows that go into the African continent. Similarly, for the growth of the African labor force, Africa will account almost 70% of the total increase in the global labor force by 2050. Another important point, as I answered in the chat, is that some of the African countries have performed really well at the global level by global comparisons to the crisis. If we look at the Foreign Policy's COVID-19 Global Response Index, countries like Kenya, Ghana, Ethiopia, or Senegal fared better than most of the G20 countries in the pandemic response. So I think that's pretty good news for the African continent, and also for governments in African countries. Let me now turn to policy implications. First one on the finance. So financing, we had before the crisis, the amount of financing per capita had decreased by 18% for domestic revenues, mainly for tax policies, and by 5% for external financial flows between 2010 and 2018 during the 8 years period. And this is further exacerbated by the crisis. So this is to say that the pre-crisis vulnerability have been exacerbated. So the key to this will be fiscal policies and a good management of debt and debt policies, while increasing the fiscal space, while at the same time ensuring macroeconomic stability. And this will require, again, differentiated responses for the countries. If we look at the type of debt that countries have contracted, middle in 45% of the debt from the middle income countries came from private lenders, compared to only 14% for the low income countries. And the total share of the private lenders has increased quite considerably from 24% in 2008 to 40% in 2018. So this requires different type of actions for the different countries. Similarly, with regards to debt transparency, certain countries, by some estimates, by Reynard and others, certain countries do not declare almost half of the debt officially through international sources. So, and that increases the risk perception for bondholders, but also for investors. So that's particularly important, and this is where governments can act decisively. So I'll go quickly on these points. There are many other issues that we could highlight. I'll go quickly on the point on digital transformation, because it's crucial, and we also launched the report of the African Union in collaboration with the OECD Development Center at the PIDA Week on Africa's digital transformation and quality jobs. So it's 350 pages of wisdom, which I welcome you to read. And it highlights, I think it highlights a very important point on the digital transformation that was highlighted by the previous speaker on inequality and the spatial inequalities in particular. We have a very big opportunity on the continent to make investment in intermediary cities to spread the knowledge and diffusion through technology, through digital infrastructure, by lowering the cost of data and other things, and to better access and diffuse knowledge to the rural areas, because intermediary cities play a pivotal role. At the moment, more than half of the most dynamic startups are concentrated in only 5 big cities. So these are the Lagos, Nairobi, Cape Town, Johannesburg, and Cairo that we know, but there's a lot of activities in the rural areas and in the intermediary cities. If I bring you some statistics, only 26% of the rural population have access to the internet compared to 47% in the urban areas. And the rural-urban interface that comprises cities of less than 500,000 people and the rural population will continue to make up 75% of the population by 2050. So there's big potential there. And most of these cities are only 10 kilometers away from the internet backbone networks. So by linking them to the internet access and making access more to digital data more affordable, we can really leverage a lot of inclusion for women who've been particularly vulnerable to the crisis because they are in services, in trade, in tourism-related activities, and in informal activities. And policies have not been gender sensitive enough, but also for the whole population and different types of vulnerable groups. We estimated that if we were to reduce prices to access to data by 50%, 75% of the African population could access to data. So we made 4 policy recommendations there in the report. I won't go into all of them because we don't have time, but I would like to emphasize the last point is the potential for coordination by the African Union, by the Pan-African Organization, with the regional economic communities and the national governments. It's particularly important in the digital area. There's a lot to learn by exchanging with other regional organizations like European Union and others who have capacity, who have also done wrong things and failures. So there's also things that can be learned from abroad or things that should not be done. Let me mention that the African Union is leading over 15 initiatives to harness digital technologies, but a lot can be done to better harmonize the data, facilitate the exchange of data and the interoperability of systems for hard infrastructure. For example, for data protection, only 28 countries in Africa have comprehensive personal data protection legislation in place. So more can be done there to deploy that and to harmonize across the countries. Thank you very much. I won't go into all the points I mentioned.
Yeah.
Too much for 5 minutes. Thank you.
Yeah, thanks so much. Thanks so much, Dr. Arthur. I really value your very excellent contribution there. So I know we are almost, towards the end of our workshop. But I just would like to ask my SIA colleague if I can have 2-3 more minutes. I'd like to go back to presenters. So we have like a few questions there. Some of them have been answered already. But the 2 things I pick up, one is more about the gender, how the country are approaching gender, or whether or not, the pandemic response, in relation to the gender, kind of lens is enough or not. So that was the one. And second was one on the, I think there was a question from, what is her name? Ulito. Yeah, she was asking like, given the urgency of climate change, because we need to really take a bigger action there, but at the same time, given the poverty and inequality in the continent, how you go about kind of balancing, striking that balance between the climate and the economic recovery and the addressing the poverty issue there. So any presenter, like either Ma or Ian, or we would like to just like, you have 1 minute. Ma, maybe perhaps you can just quickly, a little bit gender side and inequality side, maybe you can, just like you have 1 more minute, not more than 1.
Okay. So the preliminary findings show that the responses so far haven't been very gender sensitive. However, the research team is working towards doing a more in-depth analysis with regards to gender and also with regards to climate considerations. And so it will be interesting to look out for subsequent research papers that will come out of the project for that.
Fantastic. So, Adidesi or Ian, would like to come in, like 30 seconds for each of you?
Oh, sure. Maybe I'll just say that with the trade-off with climate and investing today, I think if governments are taking a long-term perspective, then climate is a good investment today, because it's going to benefit in the long run in terms of reduced climate-related disasters and the economic consequences associated with them. So I think this is the main sort of purpose of the government when investing, is to internalize the long-term rate of return that maybe short-term investors are not internalizing.
Thank you so much. Thank you, everyone. Obviously, I'm not going to summarize, what last 2 hours of discussion. Thanks so much for everyone, all our presenter and panelists. It was really a pleasure to be with you, 2 hours this morning. And on behalf of IDRC, I really would like to congratulate you, for all your intervention and your you have done. So now I think I would like to hand over to Elizabeth. I'm pleased that she's still there. I can see her there, although I think Erin already left. So thanks again, and it was a privilege to be with you this morning, like 2 hours or this afternoon. Thanks once again, and Elizabeth, over to you. Thanks so much.
Thanks, Bim. What I'm going to do is a good rugby tactic, which is kick the ball into touch. And hope that my colleague Noema Grobelaar, the Director of Research, will throw the ball back in. Noema?
Thank you, Elizabeth. Thank you very much, Bim. I think my closing remarks will be very, very brief. A year down the line, we now know how far-reaching the impact of COVID has been on our lives, our communities, and the countries in our region. Certain groups in our societies, especially women, rural groupings, those working in the informal sector, and the poor, have been especially affected. Let us also not forget those that previously did well in the formal sector, but because they've remained disconnected from the digital economy, have been severely affected as well. The research conducted so far by our project has clearly shown that low and middle income countries have limited financial, monetary, and social instruments to deal with the impact of the pandemic. So how should we go about rebuilding our region? I'd like to highlight 4 key takeaways from the discussion today. The first is that the pandemic threatens to erase the developmental gains made in our region in recent years. This requires immediate action by governments to address the structural weaknesses in our economies that actually predate the pandemic, such as high debt levels, inefficient financial and capital markets, a lack of financial inclusion, and weak tax agencies, amongst others. Like Ade pointed out in his presentation, our high debt levels and limited fiscal space call for innovative solutions based on a data-driven approach and the importance of the digital economy as a key vehicle to foster financial and social inclusion. The second point, like Ma pointed out in her presentation, is that most policies that have been deployed thus far, tax relief, interest rate reductions, debt moratoriums, and loan restructuring, do not reach the informal sector, especially women and rural populations. It also excludes the urban poor. This means that we have to consider much better targeting and instruments, such as digital platforms, to reach those that have been particularly adversely affected and the hard-to-reach poor. The third point, and this is actually a highlight on the horizon, is that the recovery responses offer a real opportunity to consider very carefully how we can build back better, ensuring a greener, more environmentally sustainable future. Ian emphasized in his presentation that it is important to explore carefully how central bank authorities can contribute to the greening of financial systems through green framework legislation and macroprudential regulation to support investment towards green assets. In this respect, both green bonds and environmental funds can play an important role in crowding in private sector investment. In this respect, government also has an important role to fulfill, as environmental fiscal reform can ensure the reallocation of resources to meet environmental goals. However, he cautioned that the efficiency and distributive effects also need to be considered carefully. In conclusion, in my mind, the pandemic has exposed how interdependent Africa is with the rest of the world. Following successive global lockdowns, we have seen the breakdown of our export markets, the precipitous fall of commodity prices, the decrease of foreign remittances and foreign investments, massive financial outflows, and the related destabilization of equity and capital markets. All of these factors have had a significant impact on government revenue, and the specter of debt defaults is a real one. This is truly an extraordinary time. We need novel solutions. We should not only work on strengthening our national responses, but also focus on stronger international and especially regional collaboration. Bilateral and multilateral development cooperation is critically important, but we should also recognize that the biggest share of our debt is from private lenders. Finally, it is essential that the region focuses on collaborating more effectively. The obvious starting point is the AFCFTA, supported by a common and integrated digital platform, as Arthur pointed out. However, there's also room for important lesson sharing and learning across countries as we explore various instruments to build more resilient, sustainable economies. This is also the core purpose of this project. I would like to thank all the presenters and participants for their contributions today, with a special word of thanks to our project partners that presented here today, CC, the ASE, the SRF, and the Code. Thank you to the OECD as well. Lastly, I would like to thank the IDRC for their invaluable support to our work. We look forward to welcoming you back to the next project event. And thank you for your participation today. Stay well and stay safe. Thank you very much. That concludes our event.
Thank
we
you.
can turn on our camera for the. Can you turn on our camera for the screenshot, if possible? Yeah, I'd like to take one screenshot. Yeah.
So everybody who is there, please turn on your cameras. I think that's what Bim asked, right?
Right.
Everybody who's possible, who's able to.
Good. Good.
Have you got us?
I think so. I got one nice one.
Great. Okay.
Everyone.
Goodbye, everybody. Have a good afternoon.
Bye-bye.
Good rest of the day.
Bye.
Thank you.
Thank you.
Thank you.
Bye-bye. Bye.
Bye.